Now let's look at notes payable. Same, very similar concept, but on the other side of the balance sheet. Notes payable are going to be liabilities. This is not where you are the lender, you are the borrower. You are borrowing money from someone else, and you're paying it back over the promissory note terms. So let's look at a couple examples. Let's get rid of our assets. Bring in our liabilities. So our two notes in this situation are two notes payable, GL account 2800. We've taken out a note to buy network equipment from Allen Schaefer Technology Limited. It's a 5-year promissory note for $120,000. It was issued 1/1/2022. I'm going out of sequence here. At a 5% interest rate. And we'll do that calculation just real quick. We'll do that annual payment again for repetition. These are secured. The collateral is going to be what we purchase under these promissory notes, and the maturity date is 5 years from the issue date. So let's just do the payment for this. We're going to use our payment function in Excel. So we need to grab our interest rate. It's a 5-year loan with 5 payments. So we're going to put 5. Present value, we're going to negative what we borrowed. And again, future value is going to be 0 because they're expecting that we've paid this in full. So our annual payment for borrowing money for this network equipment, $27,716.98. Now we have this other note payable for desk and furniture, same concept. The date was issued 1/1/23, $80,000 from Al Pal Business Furniture. It's a 5-year payment term, annual payment at 6%, and it's secured by the furniture. If we default on this promissory note, they'll take the furniture back, and it's due in 5 years. We'll quickly run through the payment function one more time. So I'm going to grab our interest rate, 5-year loan, 5 payments, present value, what we borrowed, and they're expecting us to pay it back, so the future value should be 0. Annual payment of principal interest, $18,991.71. So we're going to do the same thing we did with notes receivable, except it's notes payable, the liability. We want to build out our amortization schedule to see what the balance sheet and income statement impacts are related to these notes payable. All right, Allen Schaefer Technology Limited, our principal. What did we borrow? $120,000, 5% interest. Let me get my dollars signs in there. Just I should have mentioned this earlier. The dollar signs, that will hold a cell if you want to hold a particular cell when you drag a formula down. So let's grab our payment that we calculated, and let's go through the motions. I'm going to drag all these down. If I did this right, this should be 0. Boom. 0. Payment function works. So I'm going to have 5 annual payments of principal interest of $27,716.98, and that will pay off this loan over 5 years. So let's run through this Al Pal Business Furniture Incorporated note as well. So $80,000, 6% interest. Throw in my dollar signs. Grab our payment. It's probably a better way to do that. I'm just being lazy here. Beautiful. Balance ends in a 0. That's what we want. We're expecting to pay both these notes payable off in full. Now that we have our amortization schedule for our notes payable, let's see how it impacts the balance sheet and the income statement. In this situation, since these are notes payable, these are liabilities, we have interest expense. We're paying interest for borrowing these funds. So this is an expense that's going to be on the income statement. Grab 2023 as expense. From taking out those 2 promissory notes, we have $9,714 of interest expense. grab 2024. And you can see, just like interest income, if we don't take anything new out, interest expense will go down as we pay off these loans. Let's switch to the balance sheet. A little bit of a nuance with note payables, because with note payables, we need to break out the current portion of the note payable that is due versus the non-current. Current would be anything that's due within a year. Non-current would be anything greater than a year. So let's just start with the non-current piece. And I'm going to make the same assumption we did with note receivable. We're making that payment the first day of the following year. So we're not making it in the year that it's due. So let's grab 2023, our principal, our interest that is accrued. You do want to include the interest. You can break this out separately. I'm being lazy. I'm just including it with the note payable in this situation. And we'll grab the 2023 balance for Al Powell along with Alan Schaefer. That's the total amount that is owed on those promissory notes as of December 31st, 2023. I do need to break out the current portion, which effectively is just the payment. All right, that's our current portion. Now I got to make sure, because I have the whole amount here, that I back it out on my non-current section. Let's just tighten up our formatting right there. So in this situation, the current portion of the note payables, the two annual payments of $46,709, that's the principal and the interest. And the remaining principal balance is $141,288. This is due beyond 1 year. Let's do the same thing for 2024. Gonna grab principal and interest. So that is the total amount due, but now I also want to grab the payment, because that is the current portion that is owed. It's effectively the same amount year over year. We're paying the same payment. But I want to make sure I back this out from the total. There is my note payable, non-current liability, and there is my note payable, the current portion that is in current liability. It's broken out on the balance sheet in this situation. Well, let's look what we have going on here. We're looking at our balance sheet. We have two separate buckets, very similar concepts with the promissory notes, but one is an asset. We have lent money out to other parties, and they are paying it back. That is a note receivable. That is an asset. We're expecting to receive that money along with interest. On the flip side, in the liability section, we have notes payable. This is where we borrowed money. We owe money to people. We're expecting to pay money from our cash account to pay off these loans, and we're going to be paying interest along with paying back the loan as well. Same concept, just the opposite side of the balance sheet, and has different effects on the income statement. Notes receivable will generate interest income. Notes payable will generate interest expense. Well, I hope that'll help you learn the difference between a note receivable and a note payable. I will see you in the next video. Have a good rest of the day. Take care, and goodbye.